For today's investment advice from legendary investor Warren Buffett, we'll be taking a look at his 1993 letter to shareholders, in which Warren Buffett gives us a crash course on his perspective of investment risk. Warren Buffett points out that his assessment of investment risk differs from the academic definition of risk. In academia, investment risk is normally measured by beta. Beta is a statistical calculation that measures the relative volatility of a stock versus the broader market, say the S&P 500. The more volatile a stock is compared to the overall market, the riskier we say it is. In simplified terms, the overall market has a beta of 1, and other investments are compared to the overall market. For example, if stock A has a beta of 2, then on average, its price swings are twice that of the market. If the market goes up 2%, stock A would on average go up 4%. If the market goes down 2%, then stock A would on average go down by 4%. The degree of volatility in a stock is what many define as risk of a stock. Warren Buffett is skeptical of the idea of measuring investment risk with beta. Employing databases and statistical skills, these academics compute with precision the beta of a stock's relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, however, they forget a fundamental principle. It is better to be approximately right than precisely wrong. True story time. In one of my upper-level finance classes, the professor held a competition at the beginning of each semester in which students would select a number of stocks, 10 I believe, and at the end of the semester we would see who had the best performance. My strategy was to pick the 10 highest beta stocks, hoping for a positive volatile swing to win me the competition. A semester was roughly 4 months, so you wouldn't win the competition if you picked slow-moving companies. I didn't win the competition. Now back to Warren Buffett. Warren Buffett, instead of shying away from volatility, welcomes volatility. In fact, the true investor welcomes volatility. Mr. Market, an obliging fellow who shows up every day to either buy from you or sell to you, whichever you wish. The more manic depressive this chap is, the greater opportunities available to the investor. That's true because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. We can observe Warren Buffett's above thinking during the aftermath of a stock market collapse. Take the dot-com bust. While it makes sense that tech stocks with high valuations and very little profit drop like a rock due to financial gravity, but why would companies that have no real technology exposure be affected by the dot-com bust? Companies like Walmart, which saw a 23% decline in the year 2000. If anything, it could be argued that the bankruptcy of many online retailers like Pets.com benefited Walmart. Warren Buffett prefers a more hands-on approach to assessing the company's risk, examining the company's management, competitive advantages, economics of the industry the company operates in, and intangibles, such as the company's brand. Rather than try to reduce the complex idea of risk down to a single number, a single definable number is useful for making calculations, writing formulas, and academic papers, but its usefulness for properly assessing risk, a highly complicated concept, is questionable. Warren Buffett lays down his primary factors when evaluating the risk of a company. 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both at its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. 4. The purchase price of the business. 5. The levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. Now, besides the purchasing price, which is also debatable, all of these criteria have a degree of fuzziness to them. Taxation can change over time due to changing legislation. Long-term inflation is notoriously difficult to predict. Management can change with time, and long-term economics can also change with time, as Warren admits. Did we foresee 30 years ago what would transpire in the television manufacturing or computer industries? Of course not. But the fuzziness of the calculation doesn't bother Warren Buffett. As he said before, it's better to be approximately right than precisely wrong. It is better to recognize the limitations of your ability to calculate and assess risk than to try to reduce risk down to a singular number like beta. Certain companies are easier to assess than others, especially given your own specialized knowledge. If you're a sales manager for a toy retailer like Toys R Us, then you're probably better equipped to analyze and evaluate the risk and potential of toy manufacturers than, say, biopharmaceutical companies. As Warren puts it, in many industries, of course, Charlie and I can't determine whether we're dealing with a pet rock or a Barbie. We'll stick instead with the easy cases. Why search for a needle buried in a haystack when one is sitting in plain sight? By recognizing his limitations, Warren Buffett only invests in businesses that he has confidence that he can assess to a reasonable degree with fuzzy numbers. This leads him to invest in a small number of companies, as Warren puts it. Therefore, we adopted a strategy that required our being smart, and not too smart at that, only a very few times. Indeed, we'll now settle for one good idea a year. Charlie says it's my turn. Thanks for watching. I hope you learned something from Warren Buffett's letter to shareholders. Please like and subscribe to the Strange World of Econ channel. It's a great free way to support the channel so I can bring you more investing advice from legendary investors. Till next time.